Hey YouTube, welcome to my channel. I am your host, Triple Brain. This is my first YouTube video and I'm very excited to showcase my own research methods and strategies before taking on any trade. On this channel, I will be presenting my due diligence or DD for securities that I believe deserve greater exposure to the market, and this typically identifies the stocks that are undervalued, overlooked, or has high potential for a breakout. Now, in order to keep the information categorized and easy to digest, I will most likely divide my research and findings into separate videos, each with its own focus on three primary elements. So the first primary element is a discussion of the general characteristics and features of a company. This will include a review of its products and services, the industry and market size, and attractive sell points that separate the company from its competitors. The second element will include a comprehensive breakdown of the financial metrics of a company. And here I will examine S1 filings, explain the key indicators and financial health, and discuss the outlook and growth projections that I anticipate. The third and final element will be a video explaining the technical side of a stock's performance in the market. Here I will assess key indicators, trend lines, trading patterns, volume activity, option chains, Greeks, RSI, MACD, among all other types of variables associated. I want to especially note that my channel is strictly for educational purposes, and everything I say moving forward is only a projection of my own findings. I do not provide financial or trading advice, and that any trade I discuss is my own risk management. So I hope you enjoy the rest of the video. So in this first YouTube video, I want to highlight a few things about the stock market that I think is critical to understand. The stock market is a risky place that offers an opportunity to achieve short and long-term profits. But make no mistake, nothing is a guaranteed win. Especially since the onset of COVID-19, the market spiraled into what felt like a never-ending pit in March, and then rebounded into a year-long bull run. Personally, I remember watching stock futures and pre-market action like a spectator at a boxing event. It was unpredictable, oddly exciting, and the type of movement that would give most sane investors irregular heart palpitations. But just about any long or bullish position following March lows would have returned 3 to 4 digit percentage returns, which is probably why most people think the market is literal free money. But it's exactly that type of mentality that results in significant losses for traders and investors when the market decides to turn on its belly without warning. Most people are hurling money that they can't afford to lose into day trading equities and options, and others go as far as taking their IRAs and 401ks and actively YOLOing into penny stocks and highly volatile instruments. Especially in the past few months, the stock market has given a lot of traders and investors whiplash, moving double and even triple digit percentages intraday. It's almost become a normality to stomach these types of wild swings in the market, and I think most people are becoming desensitized to the risk involved here. I don't want to shine a light onto the GameStop and AMC situation here today because I don't want to add to the boiling pot of information and misinformation surrounding this situation. The star of today's video is Rocket Companies, ticker symbol RKT. I have prepared a PowerPoint to better address the information that I've collected, and I hope this provides a better look into the dynamics of the business model. So let's take a moment to appreciate Rocket Companies, as it is a company that has an outstanding reputation in the fintech world. I think this company deserves greater attention for its major accomplishments in the 3 decades that it has been providing excellent products and services to customers across the United States and Canada. This company is a company that I've been tracking since word of its IPO was hinted to the public market back in August. I was very excited about the opportunity, seeing that this company has built a very positive image through its involvement in charity work, sporting events, and community improvement projects. In fact, during its pre-IPO, I had the chance to read most of the S1 filing and learn far more about the company than what any news article or financial journal could offer. I gained a lot of conviction in the prospects of this company, not only because it has built a financial fortress over the years, but because after being in business for so long, it still continues to improve and adjust to the growing trends of going digital, which many mortgage and lending-based companies have failed to do. So I do genuinely believe that this company still has a lot of room for expansion of its products offered, and it's positioned incredibly well for future acquisition and partnerships. So here I've prepared a table of diligence so you can get an idea of what this video is all about and how the information is laid out. I'll go over points 1 to 8 for this video and leave the financial metrics for the next video, where I'll probably be discussing in detail about how and why Rocket Companies is in such good financial standing. For this video, I hope to share with you some insight into the history of the company, what this company is all about, some financial and market statistics behind the industry, and what exactly sets Rocket Companies apart from its leading competitors. So moving along, I think it's a good time to briefly discuss the history of Rocket Companies because it's had a relatively convoluted history of name changes to compensate for the growth and expansion of their products and services. Rocket Companies was founded by Dan Gilbert in 1985 and headquartered in Detroit under the lesser-known Rock Financial's name. Now, Rock Financial's was a brick-and-mortar mortgage business that was largely successful in opening new channels for the real estate market and even attracted the attention of Intuit, which acquired Rock Financial's in 1998. Rock Financials was then rebranded as Quicken Loans, which is the more household name that people have recognized for nearly 2 decades now. But 4 years after its acquisition, Dan led a group of private investors to repurchase Quicken Loans. More recently, Quicken Loans was rebranded as Rocket Mortgages to attach itself more closely to the Rocket brand of family companies. It's more important to note that Rocket Mortgage is the flagship company that spearheads much of Rocket's success in its early stages of transitioning into the fintech space. But in the last decade, Rocket Companies has diversified its business model far beyond the brick and mortar strategy. It is now a predominantly digital technology finance business. Now, in this slide, I'll be discussing a bit further about the structure of Rocket Companies. I think a major setback that's hindering its attractiveness as a security in the stock market is that most people recognize this company as a single entity, when the reality is that Rocket Companies is a family of subsidiary businesses and services that operate together like a financial ecosystem. So it's packaged as an all-in-one business model where all lending needs are met and where many of its ancillary services work in conjunction to make the lending process easier and more efficient. So say if I'm looking to purchase a home, I need a mortgage loan, which Rocket Mortgage can provide. But for my new home, I might want to have it furnished and maybe buy a new car to go along with this purchase. Well, Rocket Companies has many subdivision businesses such as Rocket Loans and Rocket Auto that can meet the needs. So I wouldn't have to go around to Wells Fargo for a mortgage loan, then Patelco for a personal loan, and then Bank of America for an auto loan, right? Rocket Mortgage has a lot of incentives built into its network of businesses and partnerships that encourages its customers to carry out all of their lending needs under the umbrella of the Rocket brand. So before I get carried away here, I want to reiterate that Rocket Companies is in fact a collection of subsidiary businesses. They have developed a list of proprietary digital technology to assist their broad customer base to ensure satisfaction throughout the entire lending process. They also work with many independent brokerages to extend their clientele through a referral and reward system, which has been an active model in their business structure lately. So the notion that Rocket Companies are deterring the independent brokerages business from making ends meet, that's absolutely untrue. They support them just as much as they compete with them in this open market. On the topic of diversification, I want to dive in a bit deeper into the many companies and brands associated with Rocket Companies to show you the magnitude and reach of this company. It's really astonishing just how large this network of companies really is. So I'm going to shift over to their website to show you the 80+ brands and companies associated with Rocket Companies. First up, we have the Charity and Community Relations Division. This includes the Gilbert Family Foundation, the NF Genetics Research Project, and Rocket Community Fund, all of which operate as a philanthropic arm of the brand. As mentioned previously, Rocket Companies is a major sponsor of many charity programs, and especially in the city of Detroit. Rocket has provided significant funding for renovation projects, creating greater access to public resources, improving the living conditions for families living in poverty, and creating new jobs to stimulate the local economy. I think recently Dan has also contributed $500 million into these projects in the city of Detroit. And while I do believe that these contributions fall along the lines of building a positive image for the Rocket brand, I think Dan is a pretty genuine guy that wants to see his city flourish for the support that they have given him over the years. Moving along into the fintech division, or the meat of the business, we have some big brand names such as Amrock, Core Digital Media, Nexus, Lendesk, and of course the core Rocket products, which I'll go over in just a moment. All of these companies contribute significantly to the overall revenue stream of Rocket companies, and I do believe each of the mentioned companies above will continue to develop its own course and root itself as a profitable and well-known brand attached to the Rocket companies. I would definitely recommend going onto their website to take a deeper look into this page to see all the companies associated and their individual achievements, because collectively they represent the parent that is Rocket companies. So scrolling a bit scrolling a bit further down the list, we see that the Rocket companies has skin in the hotel and vacation industry, which are primarily partnership businesses that help with promotion. So if you're unfamiliar with how this works, so let's say you go to a hotel, and hotels would often offer information and rewards to customers that sign up for services and products with its partnering companies. And it's also a mutually positive relationship because Rocket companies may also offer incentives for customers to stay at these affiliate hotels. So I think this is a great way to attract more customers in all corners. Going a little bit further down, we see that they have a sports, media, and entertainment sector, which Rocket companies has a firm presence in. This is because Dan Gilbert conveniently owns the Cavaliers and Cleveland Monsters hockey team, which often promotes Rocket companies through commercials, in-game banners, and merchandise stations. It's safe to say that Rocket companies has spent a large portion of their budget into marketing, which has had only positive effects, especially within the last 4 to 5 years of its business, as suggested in its S1 filings. But again, I'll go into that in the next video. The company has grown exponentially relative to its brick and mortar stages, and even compared to the last decade of their business. So let's shift our focus back to the slides for a moment here, where I will be explaining why I think Rocket companies is so successful and why it is so diverse. Here is a schematic that I pulled directly from their website to show you the core business model here. At Rocket companies, there is a diverse product offering, as you can see, where they provide Rocket Mortgage, Rocket Homes, Rocket Auto, Rocket Loans, and Rocket Connections. All of these different services and products put into an all-in-one package really meets the needs of many different types of individuals and families, and I think this is a big selling factor. By stringing these products into an all-in-one package, it really streamlines the whole process of applying for different types of loans, and I think it really does incentivize people to combine their services together. All of this then contributes to the substantially higher client retention and the customer satisfaction rate. And I really think that the big key here is convenience, right? When everything is put all into one package, it's really nice that you don't have to go to different websites, different companies, different applications to apply for these types of loans. So they really do have this convenience factor locked in, and I think this is the major core of their success. Adding to the idea of why convenience is so important, I want to say that in an increasingly digital world that we live in, we strive to create technologies and tools that help to simplify our lives. Some examples would be trading brokerages that simplify the process to invest. And we have cell phones that are putting all of your practical tools and solution all in one screen. Similarly, we have software engineers working hours on end to improve code efficiency so people can get to their destinations with a fewer amount of clicks. And even produce companies are packaging mixed vegetables into cans and bags so customers don't have to go looking too far to get all of their greens. In the same respect, this is why Amazon is so hugely successful. because just about anything you need, from products, produce, video, entertainment, books, and even your dog's favorite treats, are all in one place. It's a streamlined process that is so effortless and saves a lot of time. Rocket Companies is exactly that, but in the lending space. Let me digress here for a moment and take you into a scenario to help you better understand how Rocket Companies align their product to work in conjunction. At the forefront, we have Rocket Mortgage, which is the flagship product where customers can get their loans originated and serviced. But before going through this process, prospective home buyers typically search online to find homes available on the market as they would on alternative platforms like Zillow, Redfin, and Trulia. Well, Rocket Companies has created Rocket Homes for this exact purpose, with the exception that it is perfectly integrated to work in alignment with the Rocket Mortgage product. While this is not a novel idea that other companies haven't already tried, Rocket Companies is one of the few that has managed to build an easy, secure, and reliable platform to help experienced and first-time buyers reach their goals. I'm going to jump on over to the website to show you the user experience and the framework on here. So, as you can see, this website has a clean finish reminiscent of the Zillow and Redfin format. I want you to notice right away that the Rocket Company's branding and the implementation of multiple services and products under the Rocket family brand are visible. And also notice how Rocket really makes an effort to let customers know that they can get the entire home shopping experience done here, from searching for a home to matching with an agent, and then finally getting financed. So let's take a look at what happens when I type in a city. So I'm going to type in Oakland, California here and see what homes are available. So as I'm shifting through and looking, I see an $800,000 home with 2 bedrooms and 1 bath, 793 square feet. That is a steal. What a great deal. And let's take a look at what this looks like when I click into here. So as you can see, they provide kind of a trend report that you can look into. It does show you the price range of homes in the Oakland area, ranging from $139,000 to $3.5 million. And this will show you where this home falls along in that line. So again, a very typical format that you would see similar to the Redfin and Zillow format. But if you scroll a little bit further, you see the Rocket Mortgage branding here, and it'll show you some estimates just like any other platform would, but they would be connected with other brokerages and lenders. So we can see that these numbers are they are not fixed. You can definitely change it and adjust it, and they are definitely not set in stone. So there will be a whole application process through the Rocket Mortgage platform where you can enter your income and your assets and all this other type of information so that you can see how much you would be paying. But these are some estimates. But what I like here is that when prospective home buyers are ready to move forward with the buying process, they are greeted by trained real estate agents that provides end-to-end assistance to help the buyers get connected. All of this can be done through their simple to use and guided mobile or web-based application, and they have live assistant teams to help smoothen out any bumpy roads. So I also like the fact that on the Rocket Homes website, Rocket Mortgage seamlessly bridges into the conversation where a lending specialist or partnering brokerage in the area can guide the buyer through the pre-qualification process. They hold the hands of the customers all the way through the process, developing customer trust and satisfaction that goes a long way for returning business opportunities. So capitalizing on this interconnected network and services of products has given Rocket Companies a disproportionate leverage when it comes to attracting new customers and ultimately market share in this competitive business. So we can kind of enjoy and see a little bit more into this home. but we're going to jump on over to the next important slides. In the following slide, I would like to briefly explain how the loan origination and servicing business model actually works for rocket companies. Keep in mind, this is simply a bare bones format of the entire process, and it's not meant to explain all the minor details involved. However, I think this distilled version is perfectly fine to explain to you a summary of what happens throughout the whole loan process. This process begins with a borrower who applies for a loan through rocket companies. Rocket companies would then evaluate a borrower's ability to fulfill their debt obligations, meaning, are they able to pay back this loan? This is considered on multiple metrics such as income, debt, assets, credit history, among other things. Now, if approved, rocket companies will originate or create the loan and then deliver the funds to the borrower proactively. Next, rocket companies will sell the mortgages and loans to GSEs, which are government-sponsored entities. In most cases, this will be Fannie Mae and Freddie Mac. Now, GSEs are very similar to SBACs as they provide a medium for individuals and private investors to invest their capital into. Their essential job is to package these mortgages into a product known as an asset-backed security. There are many different types of asset-backed securities, but in the case of the originated loans, GSEs will convert the loans into a mortgage-backed security specifically, or MBS for short. Mortgage-backed securities and asset-backed securities in general are just a fancy term for a stock that is derived and supported by some form of an asset. MBSs specifically are especially attractive for individual investors and institutions, as they are typically very safe and provide great returns for less risk and in less time compared to a savings account, ETFs, physical commodities like precious metals and resources, bonds, among other things. So individual investors or institutions that want to put their money into an asset-backed security class, in this case a mortgage-backed security, will then purchase shares of the GSE company, which holds 100% of the liability and ownership of the mortgages. This is very important to note because it means that 100% of the risk involved in this loan is then transferred from rocket companies over to the GSE. And rocket companies' only responsibility in this case is to collect the monthly payments from the borrowers as they repay the loan. And this money will then get channeled back to the GSEs. What happens next is investors will get paid a dividend or interest on the money they invested into the shares. Where is this money going to come from? Of course, this is the same money that the borrowers are paying back. That money will then get paid as a dividend to these investors. Of course, as with any lending business, there must be a backup plan designed in case borrowers are unable to uphold their end of the repayment plan. Remember that rocket companies is still responsible for servicing the loan, or in other words, collecting the monthly repayments and working with customers to create a suitable repayment option. But in the event of a forbearance, which is when a borrower is unable to pay their monthly dues, rocket companies will do their best to protect the GSEs and their investors by paying forward the money that they've collected from any prepayments made on these loans at the start of the loan process, so they can pay the investors in the form of dividends as previously mentioned. Additionally, rocket companies has a large cash reserve of mortgage payoffs that they collected from customers that had the money to make a one-time payment to close the loans. This would ensure that even in the event of many foreclosures, they would not have to dip into their cash in hand or liquidity, and instead use the cash reserves accrued from the origination process to keep GSE investors on board. I know this is quite complicated, but please drop a comment below if you have any questions and I'll be happy to clarify. Moving along to the key metrics, I'm excited to report some of the outstanding numbers achieved by rocket companies without going too far into the S1 and balance sheet. I'll be reviewing all of this in the next video, where I'll cover some ground on the basics of analyzing a company's financial health. Here in this slide, there are three primary metrics: the numbers, the customer satisfaction, and market share. In the numbers category, Rocket Companies has recorded over $1 trillion in mortgage loan origination volume. This number is monumental in comparison to other lending institutions in this space, and it really is an impressive financial and psychological milestone. However, I think the next $2 trillion milestone is in the horizon, and it will be a very realistic projection for the next 3 to 5 years if the mortgage lending space remains intact. This reasoning is also supported by the fact that $320 billion was originated in 2020 alone, representing just over 30% of the total origination volume since its inception. These are remarkable numbers, of course, as a result of a remarkable year of real estate propped up by low interest rates. But apart from the interest rate as the obvious elephant in the room, there are also a list of other factors that likely contributed to this growth in origination volume. But let's talk about the $320 billion in greater depth, as it deserves some highlight. For better context, in 2020, there were approximately $4 trillion in mortgage loan origination in the United States by volume. If you divide the $320 billion in loan origination volume processed by Rocket Mortgage by the net loan origination volume in the United States, it works out to about 8% of the total market. In other words, for roughly every $12 that is loaned out through a mortgage in the United States, $1 is originated from Rocket Mortgage. The magnitude of Rocket's presence is very difficult to grasp because there are actually over 11,000 financial institutions in the United States mortgage lending industry. And this was reported in 2019. But only 5,500 of these institutions reported their statistics under the Home Mortgage Disclosure Act. This includes banks, savings associations, credit unions, and non-depository mortgage lenders. Again, to put this into context, the total addressable mortgage lending market is occupied by over 5,500 institutions that all want to lend their money to borrowers. Unfortunately, for many of these competitors, they only account for approximately 1 in 10,000% on average, whereas Rocket Companies easily takes up the lion's share of 8% of the addressable market. I'll provide a tad more info in the following market share column. Furthermore, Rocket Companies has achieved a full year 2020 revenue of $15.7 billion, which represents a 300% growth year over year. These growth margins, especially for a company in a relatively stable revenue industry, is quite impressive, at least in my opinion, because we're talking about a company with over 35 years of history in the business and has quietly diversified its revenue stream and product offerings, all while developing a sound foundation to transition into the fintech space, completely leaving the brick and mortar model behind. Just think that after all these years of strategic acquisitions, venture capital investments, and marketing the brand on the big screens of sports centers and television, Rocket Companies has finally broke out of the gates, stampeding over all of its competitors to achieve the top spot in the lending space, even above the perennial lending king that was Wells Fargo. This is why I'm so excited to see the fintech numbers start rolling in for Rocket Companies, and judging by the progressive numbers in the last 3 years, I'm more than convinced that this company has a value far beyond where it is today. So for analysts and critics that are trying to write off Rocket Companies as a terrible investment simply because the stock isn't moving in their favor in the short term, it's worth reconsidering because this company is just starting to tap into its fintech potential. What helps is, of course, the $900 million marketing campaigns through its esports entertainment channel. And on top of this, the $2 billion cash flow, which many S&P 500 companies do not have. In the customer satisfaction category, Rocket Companies reported a 91% full year 2020 client retention rate. The S1 filings define this as the percentage of clients that are either returning for the reactivation or renewal of similar products and services, or subscription to an affiliate product under the Rocket Companies family of brands. I'm going to shift over to the website for just a second here to show you that they do provide the metrics here that you can see. $320 billion in mortgage originations, $15.7 billion in total net revenue, 91% client retention rate for 2020. For comparison, a 91% retention rate in the fintech sector is 3.7 times higher than the industry average, which is in itself very, very impressive. But From a separate research note, the major factors that lead to clients shifting to alternative platforms in the financial sector is due to the lack of support, inadequate levels of transparency, competitive advantage by other companies, and poor communication to maintain long-term contact. These are exactly the values that Rocket Companies preaches and trains to their 24,000 staff members. And bridging back to the all-inclusiveness of their products, it's hard for any customers to switch otherwise. And I guess that's the way Rocket integrates their products to feel like a streamlined service, which makes customers feel like there's no better alternative than to be loyal to the brand. On top of the high customer satisfaction, which is represented through the client retention numbers, we also see that in 2020, Rocket Companies managed an average of 7.8 loans per staff member per month. This is well over 3 times the loan origination frequency compared to the industry standard. And again, this is all thanks to the unmatchable service that Rocket provides. But above all, the demographics is an essential piece of the statistics that sheds light into the trajectory of its customer base. Where many financial service providers retain a high proportion of baby boomers and the Gen X, Rocket Companies has appealed to the younger millennial generation, which will be a critical component for their future growth. Simply put, the millennial generation will provide generational business opportunities as they have more chances to purchase homes, refinance mortgages, and take on larger debt compared to their earlier counterparts. It only makes sense that Rocket Companies would want to appeal to the younger mass because paired with a high client retention rate, this is revenue for the next few decades. But we also can't forget the digital element of Rocket Companies, which is expanding their digital footprint every year. In 2019, there were 73.8 million site visits, which has seen a 300% growth from 2017. The statistics behind this company just never fails to exceed my expectations, and I'm looking forward to the upcoming quarter where hopefully they have yet another surprise like the special dividend of last earnings. The final metric on this list is the market share, which I've briefly discussed already. In terms of the entire addressable loan origination market of $4 trillion per year, Rocket Companies currently occupies around 8% for the full year of 2020. Another important note that I didn't address earlier was that the top 5 mortgage companies actually takes up 17% of the market, where the top 25 companies cover 33.2% of the market. But again, Rocket Companies makes up nearly half of the market share of even the top 5 on the list when it comes to sheer volume. These competitors are well-known names such as Wells Fargo, United Shore Financial, JP Morgan Chase Bank, and Bank of America. What's more interesting is that we are beginning to see declines in the origination volume in leading competitors such as Wells Fargo and United Wholesale Mortgage, which further highlights the importance of the growth that is observed in this company year over year. And currently, the compound annual growth rate for the sector sits high at 19.2%, which is another way to say that the industry is growing from a revenue perspective of 19.2% each year. This is only positive news for the company as it continues to absorb more of the market share. The underlying significance of this is that Rocket Companies is positioned in a prime spot to continue pulling in market share each year and potentially cannibalizing smaller financial service institutions that are in this market. This is simply a natural phenomenon where consumers tend to gravitate towards the biggest names in the business because brand recognition is synonymous to quality and reliability. And with such a disproportionate disadvantage, the consolidation of borrowers into a few brand name lenders is inevitable. Moreover, a digital race exists among competitors in this lending space, and establishing an application or web-based infrastructure such that Rocket Companies have already accomplished is going to be very tough to beat out. So all in all, I think that Rocket Companies has a high potential to be the Amazon of the lending market. So just a few final thoughts and a summation of the secret sauce behind the company's success. Rocket Company's marketing strategy has made it a household name, and by promoting the concept of convenience in lending, this attracts a greater range of prospective customers in the long term. I also want to note that packaging these products and developing them into separate flagship products is both costly and difficult, which is why many competitors are unable to mimic this model. Especially with the use of sports media, venture capital partnerships, and philanthropy, it puts their branding in multiple channels that would otherwise cost significantly more to do manually. In terms of diversification, putting the eggs in multiple baskets is the hallmark for success. This allows rocket companies to minimize the risk of over-leveraging into a product while increasing exposure in different industries, diversifying the customer base to acquire a younger audience, and having several streams of income in case one product becomes outmatched or experiences a branding fallout. In my opinion, segmentation is just an all-around logical way to run a business as it increases fluidity in the workplace, organization, and cost effectiveness. Lastly, I want to add that there is a silver lining to COVID for this company. The lowered rates have increased demand for home buying and in turn catalyzed the growth in mortgage origination volume. Likewise, there is also a refinance boom as borrowers are racing to get lower rates, and this only adds to Rocket's revenue while rates remain low. And of course, we shouldn't forget that work from home mandates also contributed to the spike in home buying across the nation, as people are able to live further from their work sites, and many are even moving to remote areas across state borders to find residence because they are sometimes cheaper. This type of movement may help to increase the reach of the brand to areas that have less exposure to the branding because their consumers are also a marketing agent at the end of the day. I want to say a final thank you for those of you that have stuck throughout the whole video. I know it was long talk about rocket companies, and this is just kind of the very surface about the characteristics of rocket companies. I haven't gone over the S1 filings, the financials in detail, nor have I gone over the technicals of the stock and all of those other factors. So I'll be talking about those in the coming videos. But please drop a comment below and let me know what I can improve or something that you liked about this video or maybe something that you learned. Thank you all for watching. I appreciate it.